Really good to be here with you. I always enjoy any excuse to be in Cape Town, having grown up and lived in Joburg my whole life. I'm the CEO and co-founder of Bridgement. We're a fintech business. We provide short-term working capital facilities up to 5 million rand. Businesses can access them in a matter of hours. Our record to date is about 90 minutes. But tonight I'm here to talk a bit about digital finance in general and what it means for your business and what's going on in the fintech space when it comes to financing businesses. So before jumping into all of that and talking about what fintech is doing for business finance, the sort of first question to answer is, why is it so difficult for small businesses to access finance? Why do banks and other traditional lenders out there not service them very well? And it comes down really to three main reasons. The first being that banks and other traditional lenders are moving away from relationship-based lending in an effort to standardize and formalize their lending criteria and to increase automation as much as possible. They're moving away from lending and providing finance based on relationships, and that ends up hurting SMEs the most. It means that qualitative factors, like the characteristics of the business owner, are no longer taken into account when making a decision. And rather, very high-level basic data that you get from, say, a credit bureau is used in making those decisions. The second reason is that small business loans are not very profitable for banks and other traditional lenders. And there are a bunch of reasons for that, but there's a lot of complexity and costs in the underwriting of a small business loan. And another part of the problem is that the cost of providing that loan for a bank, it costs them the same to provide a small loan as it does a much larger loan. And so they end up optimizing for and focusing much more on larger businesses and larger finance deals, and that ends up in smaller businesses being overlooked. And lastly, the experience that business owners go through in trying to obtain finance from banks is really not ideal. On average, businesses are spending up to 30 hours spread out over 5 weeks applying for finance for their business, and that's just time that a business owner doesn't have. So some of the key challenges in offering finance to small businesses is that, one, smaller businesses tend to be more sensitive to swings in the economy. Two, they tend to have higher failure rates. They're less established. They cannot weather a knock to their cash flow, for example, as well as a large business could. They have fewer assets to put up as collateral. And lastly, there's a massive issue with information opacity and non-uniformity, meaning that it is not easy to access data on a small business and to use that in your underwriting process, or to use that to assess them and make a credit decision, essentially. And secondly, the non-uniformity of that data makes it even more difficult because every business is so different to the next one because of the stage or the size of their business, but also more importantly, because of the industry or the sector that they're in. And all of this results in a credit gap, which is defined as the unmet need for credit amongst small businesses, SMEs in South Africa. That's the demand that they have that's not being met, being 86 to 346 billion rand. Now that's a wildly large range. But even if you look at it on the low end, it's a massive problem that definitely needs solving. Obviously a large portion of that is also a lot of businesses that have small business owners, entrepreneurs that have unrealistic expectations. You'll have a guy, and we see this almost every day, who'll come to us and apply for a 5 million rand loan, but they haven't traded for 1 day yet. Obviously a lot of that is unfundable, but even if you strip that out, there's still a massive credit gap that's not being solved. And so that's where fintechs come to the rescue, and they're coming and disrupting and simplifying access to business finance. And what this means for you, the business owners out there, is that it means quick and easier access online without the need for any paperwork. It means fairer and more personalized rates and improved financial inclusion. So businesses that previously were being declined or overlooked are now being included and being offered business finance. It means more transparent pricing that's actually understandable. I don't know how many of you actually understand how your bank charges you fees on your bank accounts. I have no idea. But fintechs are introducing simpler and more transparent pricing that business owners can really understand the true cost of their finance without all of the additional complexity and hidden fees that you see with traditional players out there. And of course, more flexibility, and I'll touch on that shortly. And lastly, there are also this new wave of fintechs and the new data that is available for these fintechs to create products on is resulting in newer products being made available. So new financial products that cater and are more personalized to specific business use cases. So on the quicker and easier access note, what fintechs are doing, one example being Bridgement, is enabling a business to obtain finance in a matter of hours. And the application process has been reduced from an average of 30 hours over 5 weeks to a matter of minutes. At a click of a button, you can connect, for example, your cloud accounting package or your bank account and use that data in your application process. And that removes the need for any paperwork. So there are no longer long forms. There are no longer needs for annual financials and management accounts and all of that. If you're on a cloud accounting package, you could click a button and apply with your accounting and financial information. So another interesting thing that what fintechs are doing is leveraging this vast amount of data that's being made available out there. And that data ranges from social data, so using businesses' social data, and that's obviously data on the business itself if it exists on social media, but also obviously on the business owners, directors, etc. Obviously, we spoke about the accounting and the financial data, the credit bureau data, which is the traditional sort of checkbox stuff, banking data. And then obviously there's a lot more alternative and interesting data that's being used to assess business owners. Browser data, mobile data, e-commerce data, form filling data, psychometric data, all of this being used to better assess businesses and to also assess them where, for example, credit bureau data doesn't exist, or to supplement that and get a better view and offer them a more personalized rate, and also to include them where they were being declined before because there was no data available on them. Fintechs are now able to offer those sorts of businesses finance. And there really are amazing companies around Africa doing very interesting things. There's a company called Jumo who's heavily reliant on mobile and telecommunications data and using that to assess businesses, small entrepreneurs and individuals where no credit bureau data exists. Fintechs are enabling much simpler pricing, much more transparent pricing with more flexible repayment terms. I don't know how many of you have ever taken finance with a bank and you try to settle it early or pay it ahead of schedule, and then you get slapped with a termination fee or a cancellation charge or whatever it is. And what fintechs are doing now is, because of the way that their business models have been created with simpler fee structures that don't rely on all of those sort of the obfuscation of the true cost of capital that they're providing, they're able to offer much more simpler, much more flexible finance. They enable you to take finance and settle it the next day if you want, without penalty. And so that enables you as a business owner to optimize your cost of funding. You're not stuck taking out finance for a long term when you don't actually need it. They are also removing all of the unnecessary fees around applying or opening an account, initiation fees, ongoing monthly facility fees and things like that. They remove all of those and rather introduce simpler pricing that a business owner can actually understand and can always know what their true cost of funding is. And lastly, fintech companies are creating newer, simpler products that cater for specific needs, niche products that cater for business needs. One example of that is Bridgement. We've created it's a revolving credit facility, but it is also tied to invoice financing. Traditional invoice financing, discounting, factoring has never really been a favorable form of finance for small businesses, and there's a whole bunch of reasons why. And what Bridgement's done is it's completely flipped it on its head, changed the way it's done, leveraging the tech and the data that's available to create a new product. There are also merchant cash advance products, which are very well suited to retailers and restaurants that might struggle with seasonality. And they have very flexible payment terms where they're always paying a fixed percentage of their revenue, meaning they aren't stuck paying off a large loan installment when they're on their off season. And so fintechs are introducing all of these weird and wonderful products that are catering for niche needs, solving businesses' cash flow problems and helping them fund their growth. Thanks, everyone.